Have you ever looked at the interest rate on a mortgage, a car loan, and a government bond and just wondered, why are they all so different? It can feel totally random, right? Well, it's not. There's actually a hidden logic, a kind of secret code behind it all. And today, we're going to crack that code. So, what's the deal? Why aren't all interest rates just the same? Well, the answer comes down to a handful of key factors for every single loan out there. So for this explainer, let's put on our detective hats because we're going to hunt down these clues one by one. Okay, so check this out. Here is our first set of clues, a snapshot of different interest rates, all from the very same day. Right away, you can see things that look weird. A 3-month Treasury bill was paying out a tiny 0.14%, but a 10-year Treasury bond was at 3.58%. I mean, they're both from the US government, they're both super safe, so why the massive gap? And get this, a top-rated municipal bond actually yielded less than a top-rated corporate bond. How does that even make sense? This right here is the exact puzzle we're here to solve. All right, first things first, our investigation begins with the most fundamental factor of all, time. Yep, just the sheer length of time until a loan has to be paid back, what we call its term to maturity, has a huge impact on its interest rate. This is our first major clue. You see, this relationship, this connection between a loan's interest rate, or its yield to maturity, which is really just the total return you'd get if you hold it all the way to the end, and its term to maturity, well, that relationship has a name. It's called the term structure, and when you plot it out on a graph for similar kinds of bonds, you get an incredibly powerful economic tool called the yield curve. Now, this is where it gets really cool. The yield curve isn't static. It doesn't just sit there. It's alive, constantly moving and changing shape. Look at these 3 examples from 3 different points in time. The most common shape is what we call upward sloping, like this one from 2011. But sometimes, like back in January 2007, the curve can actually invert. It can flip completely upside down. And that, right there, is a huge red flag. It often signals a recession is just around the corner, which is exactly what happened a year later with the 2008 financial crisis. So what's making these curves dance around like this? What forces are pushing and pulling them, making them slope up or down? Well, economists have basically come up with 3 main theories to explain what's going on. It's like 3 different angles for our investigation. First up, we've got the expectations theory, and honestly, it's the most intuitive one. It pretty much says what it sounds like. The shape of the yield curve is all about what investors think is going to happen with interest rates down the road. If the market as a whole expects rates to rise, the curve will slope up. If everyone thinks rates are going to fall, it'll slope down. It's really all about collective prediction. But wait, it's not that simple, right? Expectations can't be the whole story, and they're not. This brings us to the liquidity premium theory. Think about it. Locking your money away in a bond for 30 years is way riskier than for just 3 months. Your cash is tied up and prices can swing around a lot more. So, to make it worth their while, investors demand a little something extra, a bonus. And that bonus is called a liquidity premium. Okay, now look at this graph because it pulls both of those ideas together perfectly. The black line, that's what the curve would look like based on just expectations. But then you layer on that liquidity premium, that extra compensation for taking on long-term risk, and boom, you get the blue line. That steeper, upward-sloping curve is what we almost always see in the real world. And finally, our third theory is called the market segmentation theory. This one takes a totally different approach. It says, hey, maybe we're thinking about this all wrong. The bond market isn't one giant single market. It's more like a bunch of separate, smaller markets, one for short-term, one for medium-term, and one for long-term. A bank that needs cash for next week doesn't really care what 30-year bond rates are doing. So each of these segments has its own unique supply and demand, which sets its own unique interest rates. All right, so we've cracked the code on time, but that's only one piece of the puzzle. Let's move on to our next set of clues. And this one gets to the absolute heart of all investing, risk versus reward. This brings us to default risk. And in plain English, that's just the chance that the borrower, well, won't pay you back. U.S. Treasury bonds are considered to have basically 0 default risk. But a corporation? Well, any company, even a great one, could run into trouble. And that explains another piece of our puzzle from the start. The riskier Bay A corporate bond had to offer a higher interest rate than the safer AAA bond. It's the classic rule. More risk has to come with more potential reward. And this whole idea becomes absolutely critical when the economy gets shaky. Investors get nervous and they run for the hills. They start what's called a flight to quality. It's like a stampede. They sell off their riskier corporate bonds and pile into the safest assets they can find, which are usually government bonds. This flood of demand drives government bond prices up, which pushes their interest rates down, while the exact opposite is happening to all that riskier stuff. That flight to quality also shines a light on another related clue. Marketability. Basically, how quickly and easily can you sell something if you need your cash back right now? Well, U.S. Treasury securities are the most marketable financial asset in the entire world. You can sell them in an instant, anytime. That incredible liquidity makes them extra attractive, which means the government can get away with paying a slightly lower interest rate. Okay, so we've covered time and we've covered risk. Our third and final set of clues is hidden in the fine print, the details like tax rules and special features that can totally change what a bond is worth to you. And this right here, this solves one of the biggest head scratchers from our original puzzle. Why did that top-rated municipal bond have a lower yield than an equally safe corporate bond? It all comes down to one word: taxes. The interest you earn from most municipal bonds is completely tax-free at the federal level. That is a huge benefit. So for a regular taxable corporate bond to even compete, it has to offer a much higher interest rate up front, just so you end up with the same amount of cash in your pocket after taxes. Bonds can also have these special options tucked inside them. A call option lets the issuer, the borrower, pay you back early. Now, that's good for them, but it's bad for you, especially if interest rates have dropped. So to make up for that risk, they have to pay you a higher yield. On the flip side, a put option lets you, the investor, sell the bond back early. That's a great feature to have, so you're willing to accept a lower yield. Same goes for a conversion option, which lets you trade your bond for company stock, another awesome perk that means a lower yield. All right, detective, we've gathered all the clues, we have time, we have risk, and we have all that sneaky fine print. Now it's time to put it all together and see how these clues tell a story about the entire economy. And this chart lays it out beautifully. At the beginning of an economic expansion, when things are heating up, rates are usually low and the yield curve is sloping upward. But as the economy starts to overheat, the central bank usually steps on the brakes. They raise short-term rates to cool things down, and that can cause the yield curve to flatten or even invert. And there it is again, that classic recession warning we talked about. So what does this mean for us? Well, it's like a playbook for navigating the economy. When the curve is steep and upward sloping, it's often a good time to borrow money using short-term loans and lend out money with long-term loans. But the second that curve starts to flatten or invert, whoa, time to flip the script. You want to lock in your own borrowing for the long haul and only lend out your money for the short term. So, there you have it. What seemed like a completely random jumble of numbers at the very beginning, now it all clicks into place, doesn't it? You now know how to read the signs, you have the key to understanding what's really driving interest rates. Let's go all the way back to our original mystery table. Why was the 10-year Treasury yield so much higher than the 3-month? Simple. It was term to maturity and that liquidity premium. The municipal bond yielding less than the corporate bond? Easy. Taxes. And the difference between the two corporate bonds? Come on, you know this one now. Default risk. Boom, puzzle solved, case closed. So, to wrap it all up, just remember these 5 keys. The difference between almost any two interest rates you will ever see can be explained by at least one of these 5 factors: term to maturity, default risk, tax treatment, marketability, and any special options that are attached. Which leaves us with one final big question. What is today's yield curve telling us about tomorrow? Is it steep? Is it flat? Is it inverted? What does it suggest about where the economy is headed? You now have the tools to figure it out for yourself. So go take a look. You might be surprised by what you find.